The 7 signals we are about to explore are not isolated events. Rather, they are key occurrences and patterns that specifically emerge during the accumulation phases. These signals collectively indicate the systematic absorption of supply by institutional players who are strategically positioning themselves for an upward price movement. They are the footprints left by composite operator as they prepare the ground for a significant rally. By recognizing these patterns, traders can identify when supply is being effectively removed from the market, paving the way for future price appreciation. Each signal serves as a piece of a larger puzzle, helping to confirm the presence of hidden accumulation. The journey into identifying hidden accumulation begins with the first crucial signal, preliminary support. This signal represents the initial nascent signs of buying interest that begin to decelerate a prolonged downtrend in price. It is the very first indication that the relentless selling pressure, which has dominated the market, is starting to encounter significant resistance from buyers. These buyers are often the early institutional participants who recognize value and are starting to quietly enter the market. They are not yet aggressive, but their presence is enough to stem the tide of panic selling, preventing further acceleration of the decline. To identify preliminary support, traders should diligently look for specific characteristics in price and volume action. Typically, one would observe an increase in trading volume as the price continues its downward trajectory, but critically, the downward movement itself begins to slow down. The price spreads, which represent the range between the high and low of a trading period, might remain wide initially, but the velocity of the decline noticeably diminishes. This combination of increased volume on a slowing decline signals that institutional investors are beginning to absorb shares from panicking sellers, indicating that the end of the downward move may be approaching. It is a subtle but powerful shift, highlighting the early stages of demand asserting itself against persistent supply. The significance of preliminary support for the accumulation phase cannot be overstated. It serves as the very first warning that smart money is starting to engage, laying the groundwork for a potential reversal. While it does not confirm a market bottom, it alerts astute observers to the emergence of demand in an environment previously dominated by supply. It suggests that the asset is becoming attractive to those with significant capital who are initiating their buying process. Recognizing this signal early allows traders to prepare for subsequent, more definitive signs of accumulation, setting the stage for informed decision-making. It marks the transition from pure markdown to the early stages of a potential accumulation range, providing an initial anchor point for future analysis. Imagine a falling object. Preliminary support is when the air resistance starts to noticeably slow its descent, even though it is still moving downwards. The selling force is still present, but a counterforce is beginning to emerge. This early absorption of supply prevents the price from accelerating further downwards, creating a foundational level where demand is starting to assert itself. Without this initial interest, the price would likely continue its freefall, indicating a lack of institutional conviction. Therefore, preliminary support is a foundational piece in the puzzle of identifying where the market's direction might be about to change. It is about recognizing the subtle shift in the balance of supply and demand that precedes a major move, offering a glimpse into the strategic intentions of professional money. Furthermore, the context in which preliminary support appears is vital. It typically occurs after a substantial and often extended period of price decline, where the asset has become significantly undervalued in the eyes of professional investors. The public, exhausted by the downtrend, is often capitulating, creating the very supply that institutional players are eager to absorb. This dynamic interplay between panic selling and strategic buying defines preliminary support. The increased volume on these slowing declines confirms that actual transactions are taking place, not just a temporary pause in selling pressure. It is a concrete sign of shifting market sentiment, even if the general trend still appears bearish to the untrained eye, offering early clues about impending market structure changes and a possible reversal. Following the initial indications of preliminary support, the market often experiences a dramatic event known as the selling climax. This is a pivotal point where panic selling from the uninformed public reaches its absolute peak, and these shares are aggressively absorbed by large professional interests near what will often prove to be the ultimate market bottom. The selling climax is characterized by an intense emotional frenzy, as fearful investors rush to liquidate their holdings, believing the price will fall indefinitely. Paradoxically, this widespread capitulation creates the ideal conditions for institutional buying, providing ample liquidity to accumulate their desired positions. To identify a selling climax, traders must look for several distinct characteristics working in concert. The most prominent feature is a sharp, often parabolic increase in trading volume, indicating a massive transfer of shares. Alongside this surge in volume, there is a significant expansion in price volatility, with wide price spreads observed during the trading period. Crucially, despite the intense selling pressure and wide downward price swings, the price frequently closes significantly higher than its intraday low. This upward closing action, often resulting in a hammer or doji candlestick pattern, reflects the powerful absorption of shares by large players who are stepping in to buy at distressed prices. The market's inability to sustain its lowest levels, despite extreme selling, is a telltale sign of demand overriding supply. The significance of the selling climax for the accumulation phase is profound. It unequivocally signals the exhaustion of sellers and confirms the massive absorption of supply by institutional investors. This event effectively clears out the remaining weak hands, ensuring that a substantial portion of the available supply is now in stronger, more patient hands. The selling climax often marks the definitive end of the markdown phase and the true beginning of the accumulation range. It is a dramatic and often violent culmination of selling pressure, paving the way for a potential upward reversal. Without this cleansing event, the market would likely remain vulnerable to further declines, as weak holders would still be present to offload shares. Consider the selling climax as a natural disaster, a hurricane of selling that sweeps through the market. But at its eye, there are those prepared to weather the storm, strategically collecting everything left behind. These are the institutional investors who view the widespread fear as an opportunity to acquire assets at bargain prices. Their deep pockets and long-term perspective enable them to absorb the immense supply without driving prices significantly lower. The sheer volume of transactions occurring at these low prices confirms the conviction of these professional buyers, demonstrating their strong belief in the asset's future potential. Furthermore, the emotional component of the selling climax is critical. It represents the point of maximum financial pain for the public, leading to irrational decisions driven by fear. This emotional capitulation is precisely what professional traders look for, as it provides the liquidity necessary for them to accumulate large positions without excessively moving the price against themselves. The subsequent upward close, despite the initial plunge, is a clear indication that demand has overwhelmed supply at these critical lows. The selling climax, therefore, is not merely a price event. It is a psychological turning point in the market, marking the shift from despair to the quiet optimism of accumulation and laying a solid foundation for the next phase. This crucial event prepares the market for its next major move. Immediately following the intense selling climax, the market often experiences a swift and often significant upward movement known as the automatic rally. This rally is a natural consequence of the intense selling pressure having finally subsided, coupled with a sudden surge in demand. With the majority of weak-handed sellers now out of the market, even a modest increase in buying interest can easily push prices higher. The automatic rally serves as a crucial confirmation that the supply-demand balance has dramatically shifted. To identify an automatic rally, traders should observe a rapid upward bounce in price, often occurring with notable momentum. This upward movement is fueled by several factors: a genuine increase in buying from those who missed the selling climax lows, and importantly, a wave of short covering from traders who had previously bet against the market. As the price moves higher, these short sellers are forced to buy back shares to close their positions, further amplifying the upward momentum. The peak of this automatic rally is particularly significant, as it frequently helps to define the upper boundary of the impending trading range for the accumulation phase. This initial high provides a crucial reference point for subsequent price action within the range. The significance of the automatic rally for the accumulation phase is twofold. Firstly, it provides robust confirmation of the dramatic reduction in selling pressure that characterized the selling climax. The ease with which prices move higher indicates that the market is no longer saturated with sellers. Secondly, it clearly demonstrates the presence of underlying demand, which is now able to assert itself effectively. This rally is not necessarily the start of a new uptrend, but rather a strong signal that the market has found a temporary floor and is beginning to establish a new trading equilibrium. It is an essential step in validating the transition from a markdown to an accumulation environment. Imagine the market as a stretched spring that has been released. The selling climax is the point of maximum compression, and the automatic rally is the immediate, powerful recoil. This recoil is natural and expected after such intense downward pressure. The speed and extent of the rally provide valuable information about the underlying strength of demand. A strong automatic rally suggests significant buying interest and a robust absorption of supply during the previous climax. Conversely, a weak rally might indicate that selling pressure has not been entirely exhausted, requiring further market testing. It is a barometer of the market's immediate health. Furthermore, the automatic rally establishes the initial boundaries of what Wyckoff referred to as the trading range or accumulation range. The low of the selling climax forms the lower boundary of this range, while the high of the automatic rally establishes the upper boundary. Future price action within this range will be critical for confirming the accumulation process. This range is where the bulk of institutional accumulation will occur as large players continue to absorb supply systematically. The automatic rally, therefore, is not just a rebound. It is a foundational event that helps to frame subsequent market behavior, guiding traders in their interpretation of unfolding events and confirming the initial shift. As we delve deeper into Richard Wyckoff's profound insights, understanding the nuances of these signals becomes paramount for any serious trader. Wyckoff himself spent decades meticulously observing market behavior, refining his methodology into a practical guide for navigating the complexities of stocks and bonds. His original teachings offer a treasure trove of wisdom that remains incredibly relevant today, even in rapidly evolving markets. If you find yourself captivated by the power of smart money analysis and wish to master the art of detecting hidden accumulation, there is an invaluable resource that can accelerate your learning journey. For those dedicated to truly grasping the principles behind these 7 signals and beyond, we highly recommend exploring How I Trade and Invest in Stocks and Bonds. This isn't just another trading book. It is the adapted edition of Richard Wyckoff's own classic work, meticulously structured to unveil his time-tested methods for market analysis. Within its pages, you will discover how to precisely identify the intentions of large institutional players, not just through theoretical concepts, but through practical, actionable strategies. Wyckoff's own words, presented in an accessible format, provide a direct conduit to his strategic thinking. This essential guide goes far beyond merely listing signals. It teaches you how to interpret the intricate dance between price and volume, empowering you to make truly informed trading decisions. You will learn to differentiate between genuine accumulation and false breakouts, understanding the underlying forces that drive market movements. Imagine having the ability to anticipate major shifts, entering positions with confidence, and managing risks effectively, all based on a methodology proven across generations of market cycles. How I Trade and Invest in Stocks and Bonds equips you with the foundational knowledge to transform your trading approach. So, if you are ready to elevate your understanding of market dynamics and adopt the analytical prowess of Richard Wyckoff himself, don't miss this opportunity. Unlock the secrets of institutional trading and arm yourself with the knowledge to spot hidden accumulation with unparalleled clarity. Take the next step in your trading education by finding How I Trade and Invest in Stocks and Bonds through the link provided in the video description below. Your journey to becoming a more discerning and successful trader begins now. Following the automatic rally, the market often performs a crucial diagnostic maneuver known as the secondary test. This signal involves the price returning to the general area of the selling climax, specifically to test the underlying balance of supply and demand at those critical support levels. It is a re-evaluation by the composite operator to ensure that the selling pressure has indeed been exhausted and that there is sufficient demand to support higher prices. This test is vital for confirming the integrity of the newly established support. To identify a successful secondary test, traders must look for specific characteristics in volume and price action. As the market approaches the support area, which was previously the low of the selling climax, both the trading volume and the price spread should be significantly reduced compared to the selling climax itself. This reduction indicates that there are far fewer sellers willing to liquidate their positions at these lower prices, and that the remaining supply is being easily absorbed. A successful secondary test will often see the price hold above or slightly retest the selling climax low, without penetrating it on heavy volume. It is common to observe multiple secondary tests after a selling climax, each providing further confirmation of supply absorption. The significance of the secondary test for the accumulation phase is paramount. It provides robust confirmation that the exhaustion of sellers, initially indicated by the selling climax, is genuine and sustained. A successful test, characterized by low volume on the retest of support, unequivocally demonstrates that the market's supply has been effectively absorbed and is no longer a significant threat to price stability. This signal strengthens the conviction that institutional accumulation is indeed occurring and that the market is preparing for a sustained upward move. It tells us that the composite operator is satisfied with the level of supply absorption. Imagine the secondary test as a structural engineer testing the foundation of a newly built structure. The selling climax laid the initial groundwork, and the automatic rally provided a temporary bounce. Now, the secondary test applies pressure to ensure the foundation can truly hold. If it holds firm with minimal effort, low volume, it confirms the strength and readiness of the market's base. Conversely, a secondary test that breaks the selling climax low on high volume would indicate that supply has not been fully absorbed, and the accumulation process may be delayed or even fail, requiring further periods of consolidation. Furthermore, the secondary test offers astute traders valuable insights into the overall strength of the accumulation process. It refines the understanding of the trading range established by the selling climax and automatic rally. Each subsequent secondary test, especially those on diminishing volume, reinforces the idea that the market is becoming increasingly resilient to downward pressure. This provides a clearer picture of where significant demand resides and where the smart money has effectively established its defensive positions. Understanding this signal allows traders to gauge the maturity of the accumulation phase and anticipate the next potential phase of market activity, thereby enhancing their strategic foresight. A particularly deceptive yet powerful signal in Richard Wyckoff's accumulation methodology is the spring or shakeout. This event represents a brief, often sharp decline in price that temporarily pushes below a previously established support level, typically the low of the selling climax or the lower boundary of the trading range. Its primary purpose is to shake out weak-handed owners, triggering their stop-loss orders, and to trap bearish traders who interpret the break of support as a continuation of the downtrend. Following this deceptive move, the price quickly reverses and moves back into the trading range. To identify a spring or shakeout, traders must look for a price action that momentarily dips below a clear support level, only to reverse with significant upward momentum. The key characteristic is the swift return of the price back above the broken support, often accompanied by increased volume during the reversal. This surge in volume on the upward move indicates strong buying interest, suggesting that institutional players are aggressively absorbing the shares shaken out from weaker hands. The spring is essentially a bear trap designed to trick market participants into selling at the exact point where demand is about to overwhelm supply. It is a final test of available supply. The significance of a spring or shakeout for the accumulation phase is profound. It serves as a definitive confirmation that the supply of shares from weak holders has been almost entirely exhausted. By pushing prices below support, the composite operator effectively flushes out any remaining sellers, ensuring that the path for a subsequent upward move is clear of obstacles. This signal confirms that large players are confident in their accumulation efforts and are now ready to initiate the markup phase. It marks a critical turning point, indicating that the market is poised for a significant upward expansion, as the last vestiges of supply have been removed. Imagine a spring as a final, deliberate sweep of the market floor. After weeks or months of accumulation, the composite operator wants to ensure no stray sellers remain who could impede the upcoming rally. They temporarily drop the price below perceived support, creating panic and forcing out those who held on through the initial accumulation but lacked conviction. Once these shares are absorbed, the price is quickly pulled back into the trading range, leaving many retail traders on the wrong side of the market. This manipulative move ensures the maximum amount of shares are in strong hands before the true markup begins. Furthermore, the spring or shakeout provides an excellent low-risk entry point for astute traders. Once the price quickly recovers back into the trading range after the deceptive dip, it signals that the market is indeed ready for a sustained move higher. The ability of the market to absorb the selling pressure below support and reverse quickly demonstrates overwhelming demand. This event often precedes an sign of strength, making it a high probability setup for anticipating the end of accumulation and the beginning of the markup phase. Recognizing this powerful signal can significantly enhance a trader's ability to capitalize on major market reversals and secure profitable positions. Following the cleansing action of a spring or shakeout, or sometimes occurring after a series of successful secondary tests, the market often produces a powerful and unmistakable signal known as the sign of strength. This signal represents a significant upward movement in price, characterized by an increased price spread and notably higher trading volume. It is the first clear indication that demand has decisively overcome supply, and the market is breaking free from its accumulation range. The sign of strength is a critical event, validating the entire accumulation process that preceded it. To identify a sign of strength, traders should look for price action that decisively breaks above a significant resistance level, which often represents the upper boundary of the accumulation trading range established by the automatic rally. This breakout must be accompanied by a noticeable surge in trading volume, confirming genuine institutional buying interest and conviction. The price action should display wide upward spreads, indicating strong bullish momentum. A true sign of strength will not be a hesitant move. It will be a confident and energetic push higher, signaling the dominance of demand and the initiation of the markup phase. The significance of the sign of strength for the accumulation phase is paramount. It serves as a vital confirmation that the period of hidden accumulation is concluding and the market is transitioning into its growth or markup phase. This signal indicates that the composite operator has completed their buying program and is now actively driving prices higher. It tells traders that the asset is no longer merely being accumulated. It is now being pushed upwards by sustained buying pressure. Recognizing this signal provides strong evidence that a substantial upward trend is beginning, offering opportunities for long positions. Imagine the sign of strength as a rocket launching after a long countdown. The preliminary support, selling, climax, automatic rally, secondary tests, and spring were all part of the preparation and fueling process. The sign of strength is the ignition and liftoff, signaling that all systems are go for a sustained ascent. The increased volume is the engine power, and the wide price spreads are the rapid acceleration. This signal is not just a temporary bounce. It is a clear declaration of intent from the powerful forces that control the market, demonstrating their readiness to propel prices to new highs. Furthermore, the sign of strength often acts as a precursor to subsequent, lower-risk entry opportunities. While some aggressive traders might enter on the initial breakout, Wyckoff methodology emphasizes patience. The ability of the market to sustain this upward move and then potentially retest the breakout level, which then becomes support, provides further confirmation and refined entry points. This signal confirms the market's newfound strength and its capacity to overcome previous resistance, setting the stage for the final signal of the accumulation process and the beginning of a sustained uptrend. It is the definitive declaration of the shift in market control. Following a strong sign of strength, the market often experiences a natural and healthy pullback or reaction, which Richard Wyckoff termed the last point of support. This signal represents a low point reached during a temporary retracement after the initial surge of the sign of strength. Crucially, this pullback occurs to a level that previously acted as resistance during the accumulation phase, but has now been successfully transformed into a robust support level. It is a final opportunity for savvy traders to enter long positions at a relatively low risk. To identify the last point of support, traders should observe the price retreating after a clear sign of strength. This pullback should ideally occur on decreased price spread and noticeably lower trading volume compared to the preceding upward move. This reduction in volume on the pullback indicates a lack of significant selling pressure, suggesting that the retracement is merely a natural consolidation rather than a renewed downtrend. The price should find support at or near the level that was previously the resistance of the accumulation trading range, effectively kissing the old ceiling, which has now become the new floor. This retest confirms the strength of the breakout. The significance of the last point of support for the accumulation phase is profound. It provides strong confirmation that the previous resistance has indeed been converted into reliable support, solidifying the market's transition into a sustained markup phase. This signal offers astute traders a low-risk, high-reward entry point as the market demonstrates its readiness for further upward movement. It is the composite operator, giving a final nod of approval before the next leg of the rally begins, allowing latecomers or those who missed the initial breakout to join the trend with confidence. This is where the market often presents its clearest buy signal. Imagine the last point of support as a crucial pit stop during a long race. The sign of strength was the initial burst of speed breaking away from the pack. The last point of support is a brief pause to refuel and confirm the vehicle's readiness, touching down on solid ground, the newly formed support, before accelerating again. The reduced volume during this pause signifies that the market is simply consolidating its gains, not facing renewed selling pressure. This makes it an ideal moment to enter, as the risk of a significant downturn is considerably diminished, and the potential for upward momentum is high. Furthermore, the last point of support is a testament to the effectiveness of the accumulation process. The fact that former resistance now acts as strong support indicates that all available supply in that price area has been thoroughly absorbed by institutional buyers. Any attempts by sellers to push the price lower are met with resilient demand, confirming the market's underlying strength. Understanding this signal allows traders to capitalize on the momentum generated during accumulation, positioning themselves for the most profitable part of the markup phase. It serves as the final, definitive signal that the hidden accumulation is complete and the asset is ready for its sustained upward journey. We have meticulously explored the 7 powerful trading signals that Richard Wyckoff utilized to uncover hidden accumulation: preliminary support, selling climax, automatic rally, secondary test, spring or shakeout, sign of strength, and last point of support. These signals, when interpreted collectively, form a comprehensive and systematic framework for understanding the strategic actions of large institutional players within the market. Each signal provides a unique piece of the puzzle, revealing the gradual absorption of supply and the preparation for a significant upward price movement. The practical application of these signals empowers traders to read the market with a depth and clarity that goes beyond mere technical indicators. By diligently observing the interplay of price and volume, one can identify the footprints of the composite operator, anticipate major market shifts, and make truly informed decisions regarding entry into positions. This analytical approach transforms trading from speculative guesswork into a disciplined, evidence-based strategy, aligning individual actions with the powerful currents of institutional capital. It provides a robust methodology for identifying high-probability trading opportunities. Richard Wyckoff's methodology, with its unwavering focus on the fundamental principles of supply and demand, remains as pertinent and powerful for today's traders as it was nearly a century ago. Its timeless insights into market mechanics and the psychology of participants offer an enduring advantage. By mastering these 7 signals, you gain a profound understanding of how markets truly move, equipping you with the tools to navigate and profit from the hidden accumulation that precedes every major bull run. Embrace Wyckoff's wisdom and elevate your trading to an expert level.